For this lecture, we will discuss disclosures and related matters. So we will discuss certain standards or different standards which relates to disclosures or items that more place emphasis on your notes to financial statements or those items that you include in your notes to financial statements aside from your normal disclosures as to your line item. Normally, what we disclose are per line item. So, for example, for line item of cash in our financial statement, we disclose an item relating to cash. Or for inventories, so we're done with those items and we know what to present, what to recognize. And possibly if you read the whole standard, you already know the items also that will be disclosed on those line items. But we go now to your general structure of your notes to financial statements and we look on those items that we need to disclose and discuss in the notes to financial statement that even though there is no line item or there is a line item relating to this, these are special items to be disclosed. So disclosures and related matters. So first, what are the topics that are included in your disclosures and related matters? First one, we have your past eight. So this is your accounting policies, changes in accounting estimates and errors. So if you still remember, we have already discussed some tiny bits of physics as to your past eight. Next, we have your past 10, which is your events after reporting period. Past 24, related party disclosures. Past 34, interim reporting. Past 29, hyperinflationary economy. And PFRS 8, operating segments. So let's start first with past 8. So past 8, accounting policies, changes in accounting estimates and errors. So you already know that in applying or in accounting a particular item, so if there is an item or if there is an accountable event, we will recognize that item. So normally recognition including measurement, the recognition, this is what we call the accounting of that item. And we said in accounting of an item, we follow first your PFRS. So if there's no PFRS, if you still remember, we have discussed this one as the hierarchy under your past eight. First, we apply your PFRS. If there's no PFRS, you try your other PFRSs. So you must use first your other PFRS. You can also use your conceptual framework, or you can also refer to those items as to the other standards from your standard setting bodies or your publications. But take note, what we use in accounting an item, we use your PFRS. Therefore, for an accounting policy, you must select and apply the applicable IFRS. So as a rule, what is our default accounting? Our accounting policy is your IFRS. So you apply the relevant standard for your accounting policy. So for example, your accounting is inventory, the relevant standard is IAS 2 or PAS 2. Or you are to account for a property, plant, and equipment, the relevant standard is PAS 16. So that is your accounting policy. You just apply the specific IFRS. And if there's no IFRS, you follow our rules as to the hierarchy of application of your accounting for a particular transaction or event. So I hope you still remember the hierarchy we have discussed before during your midterms as stated here in your part 8. Just take note, what accounting policy? Your answer is the IFRS. You apply the applicable IFRS. Question, what is the applicable IFRS? We have three. That is either your PFRS, your PAS, or your interpretations or your IFRI. And as a rule also, remember when we discuss your conceptual framework, your accounting policy should be consistently applied from one period to another. Okay? Why? Because we said your enhancing characteristic, one of your enhancing characteristic is comparability. So your items can be compared from one item to another, it must be consistent. Di ba nasabi natin noon, consistency is the means and comparability is the goal. So that you can compare items from items, you must be consistent. And if you still remember our example here, so for example, cash. So year one, you only reported cash. In year two, you reported cash and cash equivalent. So as you can see, there are differences now as to the item. You are not consistent in reporting only cash. Can you compare the two? Not anymore because they are different. You cannot compare different items. You can only compare the same items. That's why you must be consistent. So it is a means for us to compare items. If you still remember comparability before in our introduction. Now, the question is, what if there is a change in accounting policy? So, sir, when is there a change in accounting policy? Normally, there is a change in accounting policy if there is a new standard. If there is a new standard, so for example, if you still remember, we discussed one, IAS 17, it is now superseded by PFRS or PAS 17. It is now superseded by PFRS 16. So here, the accounting policy before for leases is PAS 17, but there is a new standard PFRS 16, so there is a change in accounting policy. So what happens if there is a change of accounting policy? If there is a change of accounting policy, what we do is we account for the change retrospective. Sir, what do we mean by retrospective? When we mean retrospective, it just says that if this is the date of change, it applies to previous or prior and future periods. If there it is a if there is a retrospective change, it applies to previous or prior periods and also future periods. Retrospective. Okay. So whenever you hear the word retrospective adjustment, it means that you will adjust the previous years, including the future years. If still remember under past one, if there is a change in a accounting policy, you must present a comparative financial statement from the earliest period of change up to this period. Do you still remember that? Yes, we mentioned that before. So that is now the application of this accounting policy change under PAS 8. Because under PAS 8, since there is a change in accounting policy, what is the effect? You change it retrospectively. So if you change it retrospectively, it means that all of your previous financial statements are changed. Since they are now changed by virtue of PAS 8 and PAS 1, what is the effect? You present a comparative financial statement from the earliest period of change. Okay? So I hope you can now connect the different standards that we have discussed as to your disclosures here in your PAS 8. So as a rule, what do you need to take note in your accounting policy? In accounting policy, you apply your IFRS consistently. And if there is a change, you apply it retrospectively. So in short, normally, when is there a change? If there is new standard. But actually, under PAS 8, it provides that it is not only during a change of your standard that there will be a retrospective change or a change in accounting policy. If there is a better information results pursuant to a new accounting policy, you can also make use that one. Why? Because under the rule, diba, as a rule, you should use IFRS or PAS. But you can also deviate from that. Sir, what do we mean by we can deviate by that? If we mean we can deviate in your IFRS or PAS, if that's the case, because of a better information or for a more useful information. Remember, one of the objective of financial reporting, the objective of your financial reporting is to provide useful information. So if ever you can give a better useful or more useful information or a better information, you can also change. That way you can deviate. Sir, what is an example of your deviation from your IFRS? When we say deviation, you do not make use of the standard. So for example, IFRS provides under IFRS 15. I hope by now, if I say IFRS, that means PFRS also. So IFRS, there is IFRS 15. This talks about your revenue. revenue from contract with customers. So here, under your revenue, the accounting is straightforward. So it means that if ever you already delivered, okay? So if you have already delivered the goods, we call the delivery as a performance obligation. So if you are a seller, what is your performance obligation? Your performance obligation, of course, is to deliver the goods. The buyer, the performance obligation of the buyer is to pay. So under IFRS 15, it provides there that if ever the performance obligation is already satisfied, you can recognize revenue. Okay, so that's under IFRS 15. But what if your revenue is on account, or let's say in installment basis? So you are a business which engages in installment accounting. So in short, if you sell something, it is always on installment. So the problem in installment is that it is not 100% that you can collect all of your receivables. Therefore, at some point, some collections are not collected, or some collections are really written off or are doubtful. So, what is the effect on our accounts? The effect on the accounts is that your accounts might be overstated. Your accounts might be overstated because you already recognize the revenue, but you cannot collect it. You cannot collect it. So your revenue is too high. Your revenue is too high. So you can deviate that. We have your installment accounting or your installment sales method. Okay. So this method is not provided by IFRS 15, but you can deviate and use this one so that you can provide a useful or a better information. Okay? Remember that accounting policy should be applied consistently in accordance with your IFRS. But if there is a change, normally the change is due to a new standard, but you can also deviate if ever a particular standard or a particular generally accepted accounting principle, such as your installment sales method, can be used for a more useful or a better information. And if we say retrospective, you apply it to your previous or prior periods, and you apply it also in your future periods. Clear on accounting policy? I hope. Next, we go with your accounting estimate. So, what is an accounting estimate? An accounting estimate is a judgment per se. Normally, it is an estimation based on your judgment. So, this estimation, since they are judgments, normally they changes. So, it cannot be really measured reasonably, or it cannot be measured at its actual amount because it is purely a judgment. Since it is purely a judgment, what happens here is if in case there is a revision, how do we account it? Prospectively. So what are some example of your judgment? So let's say a property, plant and equipment. You say after 10 years, the value is only 20,000. The 20,000 is a residual value. So you cannot really guarantee that after 10 years, the value of that property is 20,000. Why? Because again, we say that is only an estimate. It is a judgment. And since it is a judgment, it is prone to changes. So if there is a changes or there is any change, you account it prospectively. Take note, accounting policy should be accounted retrospectively if there is a change, while accounting estimate, if there is a change, you account for it prospectively. So how do we account for it prospectively? We account for it prospectively if we are accounting only for future and current periods. Future and current periods. Retrospectively, including prior periods. Here, only future and current periods. So in short, if this is the date of the change, you apply it from that date. You do not apply from here. So current and future periods. Clear? Okay. Accounting estimate are judgments. Accounting policy is your generally accepted accounting principle here in the Philippines, your IFRS. So I hope we are clear. Now, under the standard, if you cannot distinguish the change between an accounting policy and accounting estimate, what is the effect? So if you cannot distinguish the change, if the change is between an accounting policy, does not distinguish the change between the two. If ever you are not sure if it's accounting policy or accounting estimate, you treat it as an accounting estimate. Why? Because accounting policy has a higher or a pervasive effect rather than accounting estimate. Why again? Because as you can see in accounting policy, the effect is that you change all of the previous financial statements out of that accounting policy. So the change is so pervasive. The effect is pervasive. It's too large as to effect. But if it is an accounting estimate, the effect is only on the current period and the future periods. Therefore, the effect is not too large. It does not affect all of your financial statements, even from the earliest date. Therefore, if you are not sure if that particular change is accounting policy or a change in accounting estimate, what is the rule? You treat it as a change in accounting estimate. So again, if you cannot change or you cannot look into the change as whether the change is policy or change in estimate, treat it as change in accounting estimate. Lastly, errors. So what are errors? So errors are omissions or misstatements. So when we say omissions, it's either you did not record it. Misstatements, there is an error in your recording. I hope you still remember your AE 100 on your different types of errors. You have your errors in which transposition, transplacement, if you still remember. So those are example of errors. So when we say omission, again, you did not include it, or you did not account for it, or you forget to account for it. While if that is a misstatement, either there is a transposition or transplacement error. So these omissions or misstatements, these are considered errors. So how do we account for your errors? You account for it retrospectively. And you already know how to apply or how to account for retrospective error. If there is a retrospective error, or when we say retrospective, you account for previous year, including the current period. Okay, why? Because there is an error in your previous periods. So since there is an error in your previous periods, you should check those previous periods. Okay, that's why it is accounted retrospectively. Okay. So in part 8, what we learned, accounting policies. If there is a change in accounting policies, retrospective. And when we say accounting policy, that pertains to IFRS. Next, accounting estimate. This pertains to judgments. If there is a change as to your judgment or there is a change as to your accounting estimate, you account for it prospectively. Lastly, if there is an error, you should account for it retrospectively, meaning at the time there is an error up to the time you learn about that error. So the current and the previous period, okay, retrospectively. So that is past 8, accounting policies, changes in accounting estimates, and errors. Next, we go to past 10. So what is past 10? Past 10 is your events after reporting period. So what is an event after reporting period? Event after reporting period is defined under past 10 as events, both favorable and unfavorable that occurs between the balance sheet date and the date when the financial statements are authorized for issue. So you have to think of two important dates here: the date of financial statement and the date of authorization for issue. Okay. So what is date of authorization for issue? Normally, financial statements cannot only be published outright. Okay. Your financial statements must first be audited. And after it is audited, it is now authorized for issue. And once it is authorized for issue, it will be issued. So ganun siya. Hindi siya basta na pagka may financial statement, okay, yun na yung financial statement natin. Ilabas na lang agad yung financial statement. No, that's not how it works in actual practice. In actual practice, if there's a financial statement, normally we audit first that financial statement, and then out of that financial statement, we authorize that particular financial statement for issue, and finally we issue it. So in events after reporting period or past 10, what is important for you are these two dates. What are the two dates important? First, the balance sheet date. Next, the date when the financial statements are authorized for issue. When we say authorized for issue, it is authorized by the board of directors that it must already be issued. Now, you all know that the date of financial statement is at times it is December 31. It is December 31. So if in case that is your date of financial statement and your date of authorized for issue, let's say, is March 15. Okay, so date of financial statement, uh, December 31, example, and the date of authorization is March 15. So these items in between those dates from December 31 to March 15, or from date of financial statement and date of authorization. So any transaction or event here is known as events after reporting period. Okay? So transaction in between date of financial statement and date of authorization of issue, we call that your events after reporting period. And these events after reporting period, we have two types. So what are those two types? First, we have either your adjusting event. Next, we have your non-adjusting event. So what is the difference between an adjusting event and non-adjusting event? So first, we go with your adjusting events. So those that provide evidence of conditions that existed at the balance sheet date. So what happens here is it exists now. Okay. So we go back to our timeline. So this is the balance sheet date. This is before balance sheet date. This is the date of authorization. This is known as your events after reporting period. Okay. So what happens in your adjusting events? These are events that happened here but exist here. So in short, for example, we have here an inventory. That inventory exists now, right? As of balance sheet date. However, there is an event happened here that pertains to your inventory. So for example, in your inventory, you should report that at lower of cost or net realizable value. You already know that one, LC and RV. So as of this date, the lower is your cost. However, after the balance sheet date, and before your date of authorization, you learned that the NRV decreased. What do we call that transaction? Yung bumaba yung value ng inventory natin during this date, we call that events after reporting period. So that particular event talks about a condition that there is already existing as of balance sheet date about that inventory. Okay? Or for example, balance sheet date. You have learned there is an explosion. Okay. So because of that explosion, you are liable. This is under PAS 37, your provisions and contingent liabilities and contingent assets, or provisions and contingencies, if you still remember. So there is an explosion. So due to that explosion, you became liable, but you do not know yet the amount of liability. You only happen to know about it during this date. So that is considered an event after reporting period because you only knew about an event, or you only know about the transaction in between these dates. And since the transaction pertains to your explosion, which is already existing at the balance sheet date, then we call that adjusting event. Okay? So long as the transaction happened in between your balance sheet date and date of authorization, and that information is already existing at the date of balance sheet, then we call that adjusting. How about conditions that arose after the balance sheet date? Ang kainabahan naman nito, sa adjusting event, kailangan meron na siya sa balance sheet date, di ba? Andyan na siya dapat, tapos may nangyari ulit dito. Tama? Sa non-adjusting naman, wala siya dito, may nangyari dito. Clear? So for example, dito nangyari yung explosion. Wala pa yan noong December 31, tama? Therefore, this is considered non-adjusting. Eto kasi, yung example natin kanina, may explosion December 31, nalaman natin lang yung amount ng liability after. So this is adjusting event. Okay? Ingat lang kayo sa data, dalawa yung kailangan yung date na tingnan. What are the dates that you need to look at? The date of financial statement and the date of authorization. Again, we have different dates. Financial statement date, date of audit, date of authorization, and date of issue. What is the important date in your past 10? Two dates are important. What are those dates again? We have your date of FS and date of authorization. You don't care about the date when it is finished auditing or the date of issuance. What you care about here under past 10 are these two dates. Once you know these two dates, madali na lang. And what do you test if that event happened here or happened here? Yun lang naman. Tignan mo kung nangyari siya dati dito, tas merong nangyari. Or merong nangyari ngayon, pero wala naman siya dati. Okay? Adjusting and non-adjusting events. Of course, when we call it adjusting, you should adjust the amounts. You should adjust the amounts. What will you adjust? You adjust the amount presented in balance sheet dates. So for example, in our first example, the inventory cost is 500,000, but you learned the NRV is 300,000. You now adjust the inventory. You should adjust it at 300,000. Okay? Adjusting event. When we say non-adjusting event, of course, you do not adjust. You do not adjust. So patch 10 events after reporting period. When is that event? When should that event happen? The event should happen in between the date of financial statement and the date of authorization. And also, you should look whether that event is considered adjusting or non-adjusting. When can we say that the event is considered adjusting? The event is considered adjusting if in case it already exists as of balance sheet date. Non-adjusting if it does not exist as of that balance sheet date. It only arose after the balance sheet date. Wala siya dito, pero nagkaroon lang dito. Eto, meron na siya dati dito, tas may nalaman ka pang info tungkol dyan after that date. Kaya nga siya, events after reporting period. Okay? Past 10. So we're done with 2, past 8 and past 8 and past 10, sorry. Past 8, accounting policies, change in accounting estimates and errors. Past 10, events after reporting period. We'll proceed to another related party disclosure. So related party disclosure. What is important here is since the standard is named as related party disclosure, what you need to know first is if there is a related party. If there is a related party, then you need to disclose these items. So what are the items that we need to learn here? First, when is there a related party? Next, what should we disclose? So first, let's define what is a related party. So related parties are considered to be related if one party has the ability to control the other party or to exercise significant influence or joint control over the other party in making financial and operating decisions. So we have here one entity and we have the second entity. So either entity 1 or either entity 2. So either entity 1 controls or has an influence over entity 2, or entity 2 has control, influence, or joint control over entity 1. If you still remember the different types of financial statements that we have discussed before in your conceptual framework, consolidated financial statement, combined financial statement, unconsolidated financial statement. So those financial statements, if you still remember, and we have touched a little bit of those here. When do we prepare again a consolidated financial statement? If there is a control. So when do we have a control again? If you have ownership over the other entity for more than 50%. Joint control, meaning equal control. So let's say two entities, so each of them has 50-50. That's why it's called joint control. How about significant influence? At least 20%, but less than or equal to 50%. Okay, take a look. Entity 1 has ownership over entity 2. When can we say there is an ownership again? If entity 1 owns the equity of entity 2. Because equity shows ownership. I hope you already know those items. So, when is there a control? Kasi tatlo yung sinabi dito eh. It is considered a related party if there's ability to control. Next, there is significant influence. Lastly, there is joint control. So first, ability to control. When is there ability to control? There is ability to control if ever it is more than 50% ownership of one entity. When is there significant influence? If at least 20% but less than or equal to 50%. When is there joint control? If at least there is an equal, or let's say there are two entities, so 50-50. Joint control means it's either you have contracted to have joint control over one entity or you have equal rights over that entity. So for example, pag tatlo kayo, di tag 33.33% ninyo. Ganon. Okay? So, yun yung rule. That's the general rule. But, here are the other rules provided under the standard. So a party is considered a related entity if you directly or indirectly through one or more intermediaries the party control or significant influence or has a joint control. So what is the meaning of this letter A? So for example, A owns B 50%. Okay. So you have significant influence kasi nga 20 less than or equal to 50 or more than 50 pag control equal naman 50-50. So we call this one significant influence. So if A owns B, this is considered direct ownership. Kaya direct. Next, paano naman yung indirect? A owns B, B owns C. A owns 70% of B. B owns 40% of C. So if A owns B 70%, in short, A has 70% of the 40% of C. So 70% times 40% is 28%. So in short, A owns C also at 28%. So what is direct here? A and B is the direct. And the ownership in C is considered indirect. But C is still considered as a related party. Why? Because the ownership is 28%. This is considered significant influence. So while 70% is considered control. Kailangan nyo lang i-test talaga yan if there is control or there is significant influence or there is a joint control. So what letter A tells you is that there is still related party whether it is direct or whether it is indirect. Okay, so directly or indirectly. Next, the party is an associate of the entity. Okay, so we have here entity 1 and entity 2. Okay, entity 1 is your investor, entity 2 is your investee. So what do we mean by investor and investee? Entity 1 purchases from entity 2. So in short, entity 1 owns the shares of entity 2. Okay? So investor C1, investee C2. Sa investment in associate. So when do we have an associate? If there is a significant influence. What is significant influence? 20% at least less than or equal to 50%. So at least 20% to less than or equal to 50%. So there is an associate. So if the party is an associate of the entity, so we have here entity 1, the investor, the entity 2 is considered the associate. Okay? The investee is to consider the associate. Alam nyo naman na yan kasi nga basta may significant influence. Associate siya. Clear? Next. The party is a joint venturer. The party is a joint venture in which the entity is a venturer. Okay. So ito naman pagka may joint control. So si entity 1, siya ay isang party in the joint control. Si entity 2, another party. So if there is a transaction between the two, they are considered related parties. Why? Because we have joint control. Okay? So that happens in a joint venture. Letter D, the party is a member of the key management personnel. Okay. So when we say the party is a key management personnel, of course, these are the personnels or those in charge with your top level decision making. So if a party is a member of the key management personnel of the entity or its parent, it is still considered a related party. Next, the party is the close member of the family or any individual referred to in A until letter D. They may include the following: domestic partner and children, and then we have your dependents of the individual or the individual's domestic partner. So, in short, any close member of the family, which is the partner or the children. So, yung asawa mo, at saka ang mga anak ninyo. Kasi yung childrens of the individual domestic partner, edi yun din naman yung anak anak mo din kasi nga asawa mo yung domestic partner. Dependents of the individual or the individual's domestic partner, normally your dependents are your children's unless you have other dependents. So for example, ikaw bahala sa parents mo. So your parents can also be your dependents. Letter F, the party is an entity that is controlled, jointly controlled. You already know this one. And lastly, the party is a post-employment benefit plan for the benefit of employees of the entity. So what is this post-employment benefit plan? So you have another party which works as your post-employment benefit plan. And that post-employment benefit plan is considered your related party. Okay, let's summarize who are your related parties. So the following are your related parties. First, so long as the three important, any of the three are is present, joint control, significant influence or control. Next, you are a key management personnel. Next, you are a post-employment benefit plan of the entity. And lastly, you are a close family member of the entity. So ito lang naman yung mga kailangan yung alalahanin dyan. Ito, e-management. Ayan. Kasi ito yung main definition, di ba? So, yan yung mga una nyong hahanapin. If there is control, significant influence, and or joint control. And the others are only a no, the others are only enumeration of the different items. What is new under this A to G is letter D, letter E, and letter G. So in short, these four items. Joint control, significant influence control. Next, key management personnel. Next, post-employment benefit plan. And lastly, we have your close family member. Okay? So we're done with who is a related party. Next, we need to learn what are the disclosures of your related party. So the following are the disclosures on your related parties. First, a related party transaction. So what is this related party transaction? This is a transfer of whatever resources, obligations, or services from one party to another. So for example, entity 1 to entity 2, nagbenta si entity 1 kay entity 2. That is considered a related party transaction. So if there is a related party transaction, you should disclose the related party transaction. So what is the disclosure about this one? You should disclose the amount relating to this one. So whatever is the balances, the terms as to your related party transaction from one entity to another. Next, another disclosure is your relationship between the parents and subsidiaries. So you should also disclose the relationship between parents and subsidiaries. When do we have parents and subsidiaries? If there is a control. Okay? If there is control, there is a parent and a subsidiary. Who is a parent? A parent is the person who exercises control. Subsidiary is the one who being controlled. If you still remember, we have discussed this one during our conceptual framework discussion on who is a parent and who is subsidiary or who is an associate and those relating interests. Another disclosure is your management compensation. This pertains, of course, with your key management personnel. Why? Because for us to determine if that particular personnel is really a key management personnel, so you must disclose the key management personnel compensation in total. So once you determine who are your related parties, which we have already know, joint control, significant influence, control, key management personnel, employee benefit plan, and then we have also your close members of the family. Once you know this, if there is a related party transaction, you disclose. You disclose also the relationship between parents and subsidiary and the compensation of your key management personnel. So that's it for past 24. Next, we go with past 34 interim reporting. So for interim reporting, what is an interim period? An interim period is a financial reporting period shorter than a full financial year. So you already know what is an annual period and what is an interim period. Annual period, 1 year. Interim period, less than 1 year. So you can report either 3 months. What do we call this 3 months? Quarterly. 6 months, we have your semi-annually. 1 month, we call this 1 year monthly. How about bi-monthly? When we say bi-monthly, you should report 2 months. Okay. Bi-month. So 1 month is 1 month. So 2 months by month. So 2 months. How about by quarter? This is 2 quarters. Yun naman yung ibig sabihin niya. Pagka-bi. Semi means half. Bi means two. Okay. So that is an interim period. So any period not considered annual period is an interim period. We go now to your interim financial report because what we know is an annual financial report. If you want an annual financial report, you go with past one. But we go now with your interim reporting. So what is an interim financial report? An interim financial report is a financial report containing either a complete set of financial statements or a set of condensed financial statements for an interim period. So this one is a financial statement for interim period. That is an interim financial report. So since we are talking now about interim financial report, what are the different financial statements under your interim report? First, statement of financial position. Next, income statement. Look at the words used. Income statement, not statement of comprehensive income. There is a difference between the two. Remember that, right? Income statement talks about profit or loss. Statement of comprehensive income is profit or loss plus items of OCI. So under interim reporting, what is included only is your income statement. You do not include the items of your OCI. Remember that. Next statement of cash flows is still present. So we have one, two, three. We have also your changes in equity, and then lastly, your notes. So in short, it is almost the same with past one. However, the difference is as your income statement because what you present here only is an income statement, while in a complete set of financial statement, we present statement of comprehensive income. So what are the rules in your items in FS? You should prorate it or you allocate it. So actually, the rule here is you only record transactions for that period. Okay, so for example, from January 1 until March 31. So this is 1 quarter. So for 1 quarter, you should only report those transactions happening during that quarter. So whatever are the transactions happening during that quarter, you report it there. But what if that transaction is considered a annual transaction or it is considered as a transaction which pertains to different periods. Okay. So for example, you have a 7 month insurance. Okay. 7 month insurance. And you purchase the 7th month insurance on February 1. So if you are to report here on January 1 to March 31, will you report the whole 7 month? No, you will only report from February 1 to March 31. Okay, that's why it says some items in the financial statement should be prorated or allocated in case it is not associated on that particular period only. It is associated to different periods. So it is intra-period. Okay? So as a rule, how do we present? You present it at the time that transaction happens. So if the transaction happened January 1 to March 31, you present it. But if that is considered intra-period or for different periods, what do? We need to prorate it or to allocate it. Okay, so in our example, we have a 7 month insurance purchase on February 1. We will only report February 1 to March 31 for our interim report. Okay, so interim period, less than 1 year. And just remember, you just need to present the items you need to present on those periods. And if ever, you should prorate for intra-period transactions, such as this one. So we have your 7-month insurance expense. So you will only report 2 months here. Next, hyperinflationary economy under PAS 29. So PAS 29 hyperinflationary economy. So hyperinflationary economy normally happens if there is a high inflation on that particular country. Normally, countries in Africa are affected with hyperinflations. But in the Philippines, we don't have a hyperinflation right now. Although we have inflation that is currently not the same inflation rate with what we have on the previous years, but we are not experiencing hyperinflation. So when we say hyperinflation, normally this is due to very, very fast, high rising prices. So your prices are rising so high, although currently we feel that there is inflation, but that is not yet hyperinflation. Like, for example, candy is worth 1 peso, and then there's hyperinflation, it's now worth 100 pesos. So that is quite considered hyperinflation. But if you have 1 peso candy and tomorrow it is 1 peso and 50 cents, that is not considered hyperinflation as to a rising price. So when can we consider a particular economy as hyperinflation? So under PAS 29, what are the characteristics of a hyperinflationary economy? First, the general population prefers to keep its wealth in non-monetary assets or in a relatively stable foreign currency. So what they do is they invest to maintain purchasing power. So what happens if ever you maintain a purchasing power? So if you keep on maintaining a purchasing power, the effect is you have a higher purchasing power. So if this is your purchasing power now, 1 peso, and you keep to maintain that, the tendency is it will only go high because you keep on maintaining it. It will never go low. Therefore, if it keeps on going high, then there is a possibility of hyperinflation. There, what is a non-monetary asset? A non-monetary asset is an asset not fixed in amount. Right? So for example, cash, 50,000. That cash of 50,000 is always fixed in amount. Okay? We call this one monetary. When you say monetary, whatever is the amount of that particular asset, that is the amount you will receive. So AR, for example, 50,000, you will still receive that AR 50,000. Cash 50,000, you will still receive 50,000. But if in case we say non-monetary, it is not fixed in amount. So you will not receive that amount as a whole. So for example, you will not receive PPE. So your PPE, the value is 100,000. So if you will sell that PPE, will you still receive 100,000? No, because the amount is not fixed. It can be more than or less than that amount. Okay? So as you can see, since you're just maintaining purchasing power, tendency going high. Next, the general population records monetary amounts not in terms of the local currency, but in terms of relatively stable foreign currency. Prices may be quoted in that currency. So what happens here is since we have a fixed amount, a monetary amount, and you place it in your stable foreign currency, again, you still maintain it. You still maintain it. Next, sales and purchases in credit take place and prices that compensate for the expected loss of purchasing power during the credit period, even if the period is short. So you purchase or you sell on credit and you compensate any expected loss in the increase in purchasing power. So for example, you have sold at 50,000, the cost is 60,000. Okay. So there is a loss of 10,000. But that loss is compensated. What do we say when we say, what do we mean when we say compensated? It means it is offset. It is offset by the increase in the purchasing power. So in short, parang wala ka lang yung loss kasi nga nakabase ka dun sa purchasing power. So if the increase on your purchasing power happens, so the prices will increase also. So in short, what happens here is as if you do not have a loss because this 60,000 now, may be worth more than what you have lost only. Next, interest rates, wages, prices are linked to a price index which is increasing, or the cumulative inflation rate over the 3 years approaches or exceeds 100%. At most, if there is a question here, you will be asked which of the following is not a characteristic of hyperinflationary economy. So you just need to know when is there a hyperinflationary economy. Okay? So these are indications of hyperinflationary economy. Please take a look at them. So when do we apply year past 29? We apply it if the economy is hyperinflationary. So for example, we have here a business which operates in a hyperinflationary economy, then you apply past 29. Or your foreign operation is hyperinflationary. So we have here a business which is in the Philippines. And you have a foreign operation that is another business, the same business but in, let's say, hyperinflationary economy in Africa, let's say. Okay, so here you have a business in the Philippines, but you have a foreign operation, the same business, which now operates in Africa, which is hyperinflationary. So you can apply it. You can apply it if our economy is hyperinflationary, or you have a business outside that is considered hyperinflationary. So how do we apply it? We use your restatement method. When do we restate? We restate your non-monetary asset. Okay? So all non-monetary items should be restated, but you retain monetary items. What are non-monetary items again? Non-monetary items are items which are not fixed in amount, while monetary items are fixed in amount. Monetary items are fixed in amount. Okay? So what we do is we restate it based on our previous purchasing index to our current purchasing index. So for example, you have a land purchased on March 1, 2015. Today is December 31, 2020. So on March 1, 2015, the purchasing index is only 120. But now on December 31, 2020, the purchasing index is 580. So how do we restate? If the land is worth 50,000, we restate this way. 50,000 value of the land multiplied by the 580 over 120. That is how we restate it. We restate it on the current price index. So this is the current price index, and the base is the previous price index. Okay? That's how we restate. But anyway, I'm just showing it to you so that you know how restatement works. So we only restate non-monetary items based on the current purchasing index, based from your current purchasing index over your old purchasing index at the time you acquired that property. Okay? Not fixed. Normally, non-monetary items are your property, plant, and equipment. Last topic under your disclosures and related matters is your PFRS 8 operating segments. So under PFRS 8 operating segments, we need to know what is an operating segment and when do we apply operating segments rule. So when do we apply your operating segments? You only apply this one on entities whose debt or equity instruments are traded in public market. So what is our public market in the Philippines? Your Philippine Stock Exchange. So once a company is trading in the public market, in short, they are listed in the public market. Example, Jollibee, McDonald's, San Miguel Corporation, those items are traded in the public market. They apply PFRS 8. But the question is, what is an operating segment? An operating segment is a component of an entity that is engages in business activity from which it may earn revenues and incur expenses. So in short, if this is San Miguel Corporation, you have different segments here: business 1, business 2, business 3, business 4. So these businesses are called operating segments. So these operating segments are different business under one particular business which engages in business activities and may earn revenues and incur expenses. So we call those as your operating segments. Under your PFRS 8, what is important here is what are your reportable segments. So from here, SMC, we have four segments. business one, business two, business three, and business four. The question now is when do we apply this one? We apply only if SMC is traded in public market, which we already know. The second that you need to know is what is the reportable segments or what are the reportable segments. So your reportable segments are based on your revenue, profit or loss, or your assets. So is it 10% of more of the combined items of your total segments? So for example, business one, business two, business three, business four, assets, 100,000, 500,000, 800,000, and then 600,000. So this total is 2 million. Okay. So you need to test if ever it is 10% or more. Okay. It must be 10% or more, and total should be at least 75%. Okay. So you test out of the total assets, is it 10% of more over the combined items? So our combined items is 2 million. 100,000 over 2 million is only 5%. 500,000 over 2 million is considered 25%. 800,000, 40%, and this is 30%. This is 10%, 10%, 10% or more. This is not. So this is not reportable segment, reportable segment, reportable segment, reportable segment. Why? Because they are 10% of or more of the combined items. And the total must be at least 75%. 25, 40 plus 30 is 95%. You met that criteria. Okay. When can we say it is reportable segments? What are the tests? Test it first on your revenue. If it's 10% or more of the combined revenue, you can also test it on your profit or loss, 10% or more of the profit or loss. Lastly, 10% or more of your assets. Okay, what is considered an operating segment? Any component of the entity which also engages in business activities. In our example, SMC has four components: business one, business two, business three, business four. What we need to know here is what is an operating segment or what can be reportable out of these segments. How do we test? If there is 10% of more of the combined item. In our example, we use your assets as a test. So what is 10% or more? Or 10% or more is business one, business two, business three, and business four. Okay? That's it for your operating segments. And that's the end of our disclosures and related matters.